So we'll start with Hindustan Unilever 1213. It's about a 164 page document. See, there was a time when every shareholder was compulsorily sent a printed annual report in India. Okay. Which means if you go and buy a share of, let's say, 30 rupees on a stock exchange, it was compulsory for a company to print an annual report, the printing cost of which might be 30 rupees, and courier it to you. Okay. And therefore during those days the size of annual reports used to be smaller because there was a printing and courier cost. And then they were changing the guidelines, and then they said that now it is okay to send soft copies. Okay, so now what companies realize is that if you have to send soft copies, there is no incremental sending cost, no courier cost per se. So all these shareholders are also possibly my customers. So why not take an opportunity and use that for advertisement purpose? Okay, so you would see that a lot of annual reports today, they will have a lot of advertisement content. So we'll quickly run through the HUL annual report. So you'll find plenty of photographs, advertisements like these. This is your content. We are more keen on looking at the consolidated financial statements today. But what we also have is standalone financial statement. Is it visible? What is the difference between the two, standalone and consolidated? Yes, consolidated is for the whole group including subsidiaries. Which means if I'm making balance sheet of only Hindustan Unilever, not any subsidiary together, then it's a standalone statement. But if we decide to add the balance sheet of all the subsidiaries together as well, club all those balance sheets, then we call them as consolidated balance sheets. Okay, so look at few of the contents here. Financial performance, trends, board of directors, business model. Then you would also come across, can you read this? Management discussion and analysis. We call this as MD&A section. This is also part of your syllabus. What does MD&A give you? What is the job of this MD&A? It gives you the opinion of management about the business. Okay, that how do they look at business going ahead 1 year, 2 year, 5 year down the line? What is the scenario in the cost sector, revenue sector? So mostly non-financial data, but opinion-based data. Okay, management's opinion about the business of the company. Then corporate governance report. What is this for? What is corporate governance? Every company that gets listed in India, it has to sign a listing agreement with exchanges. And that listing agreement will have a clause 49. That clause 49 requires those companies to have this corporate governance structure. And what it simply means is, how do you ensure that the management of the company works in the best interest of the shareholders? That area is called corporate governance. Okay, I'm repeating again. How do you ensure that management of the company, the CEOs and CFOs, they work in the best interest of the shareholders? So corporate governance. We will directly jump on to this balance sheet here. Visible? First thing that you would notice, balance sheet as at 31st March 2013. What is the significance of the word as at? So it does not mean till. It means that balance sheet is true only and only on that particular day. Which means a day before that and a day after that we had a different balance sheet. And for the simple reason, balance sheet is a total of your assets and liability. And we know that assets will keep on changing every day. Okay, so write down a sentence. Balance sheet is true. Balance sheet is true only on one particular day. In fact, within the day also you can have different balance sheets. So this is the closing balance sheet of that particular day, 31st March 2013. If you look at the heading of income statement, it says statement of profit and loss for the year ended. Okay, which means the second sentence, income statement is true. Income statement is true for the entire period. So in a way, it is showing you the performance of the company for one entire period for the year ended 31st March 2013. Are we clear with this? Going back to balance sheet again. What we learned yesterday, we learned to prepare this balance sheet on a horizontal fashion. We had equity and liability on the left, and we had assets on the right. If you tilt this and make it in this fashion, where you have equity and liability here and assets here, this is called vertical format of balance sheet or a report format of balance sheet. So most of the modern day balance sheets that you would see, you would find them in this particular format, where at the beginning you will have equity and liability, and then at the bottom you will have assets. However, the logic is exactly same, no difference. So going back again, the first thing that we check is that total of equity and liability is 12091 rupees in crores, and same is the total that we have for assets. Okay, which means the accountants of HUL seems to have done a good job telling their balance sheets. Equity and liability, first point, shareholders fund, share capital, reserves and surplus. What is the meaning of the share capital? 216.25. Amount of money shareholders have given. Amount of money shareholders have given. Okay. Any other interpretation? Huh? Capital raised through public. Okay. No, it is not. None of them. Anything else? Absolutely yes. The share capital is number of shares multiplied with face value. Okay, for example, see, it works like this. Let us say I have decided to issue 10 shares. Face value of my share is 10, but issue price is 50. How much money will I receive when I issue these shares? 500. What we will do is we will break down this 500 into two parts. Number of shares into face value, which is 10 into 10 100, and this extra 400 that we've received, what is it called? Securities premium. So for disclosure purpose, on the balance sheet we will have share capital of only 100, face value into number of shares. That securities premium would be transferred to reserves and surplus, and then every year the amount of profit would also be shifted to reserves and surplus, and this amount will keep on increasing. Is that okay? So equity share capital, number of shares into face value, and reserves and surplus, everything else. We can go and see the breakdown of these two numbers, 3 and 4. These are called notes to accounts. So note number 3, share capital, authorized, issued, subscribed and fully paid up. What is the significance of this authorized number? 225 crores. As per charter of the company or memorandum of association, this is the amount on which company has paid stamp duty. This is the amount which it can issue maximum at this stage, otherwise it will have to alter the memorandum. But this is what company has actually issued as of now, which is 216.25. Now first thing that you would notice here, last year the number was lesser by about 10 lakhs. Why do we have that increase? New shares issued. Company came up with a FPO this year. Yes? Did you hear about it? HUL coming with new issue of shares? Yes or no? So why do we have that increase? If they split the shares, face value increases? No, it does not. If they give bonus, does it increase? Yes, it does, but we don't see a ratio here. Yes. The increase in the shares is because of ESOP. ESOP is employee stock option plans, which means you allow the shareholders of your company to buy shares from you at a cheaper rate. Okay. So next time every balance sheet that you see and you find out that this amount is increasing by smaller numbers, then you would automatically know that companies may be issuing ESOPs to the employees. Are we okay here? I'll show you the breakup of reserves. This is how the reserves and surplus amount is made, and I'm sure you will see securities premium somewhere here. Yes, securities premium reserve, which means originally when the company issued, they received face value and premium. Face value was put into equity share capital and securities premium was put into reserves and surplus. Let's go back again. Next number, so reserves and surplus fairly large, about 2600. Next number is minority interest. What does it mean? Correct. It is the interest of outsiders in the subsidiaries. Okay, so what does it mean? Let us say this is Hindustan Unilever, and this year it has decided to acquire a smaller company. Okay, so in this smaller company, Hindustan Unilever acquires a stake of 80%. Now we have to prepare financial statements. As we've seen earlier, I can prepare one of the two, either standalone or consolidated. Standalone means I will prepare financial statements only of HUL, not worrying too much about my subsidiary. Consolidated means we will club these two together. So when I club these two together, the entire assets of my subsidiary are considered my assets. Entire liability of my subsidiary are considered as my liability. And then that 20% stake which I do not own in this company, this is considered as a part of minority interest, which is shown here under the equity. Is that okay? So if you'd see in India, this has been treated as a mezzanine item. What is mezzanine? Yes, it is between equity and debt. This is your debt, non-current liability, and this is your equity. Okay. Now write down one very important sentence for your exam, highly testable, 5 stars. Minority interest is treated as a part of equity in both US GAAP and IFRS. Minority interest is treated as a part of equity in both US GAAP and IFRS. Okay, which means in India we treat it mezzanine. However, in US GAAP and IFRS, we assume that this minority interest is a part of shareholders' equity. Is that okay? Market price never comes on the balance sheet. So it does not matter. The question is asked, what happens if my shares are traded in the market at a price lower than the face value? So the answer is that it does not matter what is the market price. A balance sheet or income statement never will have the market price of a stock. Okay, it is prepared based on how you perform in the business, not based on how your stock performs in the market. Is it clear? No, it does not come anywhere. The market price of a stock never comes on the financial statement. Okay, so neither does it affect balance sheet nor income statement, nowhere. No. Reserves and surplus simply means amount of accumulated profit and securities premium and some other legal numbers. I'm repeating this sentence again. Market price of a stock does not come on financial statements. However, financial statements affect the market price of a stock. The better the quality of income statement, more would be price of a stock. Any other questions?
In that case, we will not be making profit, and so we shouldn't have reserves and surplus.
Profit is not the increase in stock price. Profit for HUL is not increase in stock price. Profit for HUL is that you go and buy a Lifebuoy soap for a price of 50 and HUL makes it for 40. That is profit. Increase in stock price is not profit for HUL. Yes. So, first thing that you understand is, okay. Now, maybe I got a little bit what you're saying. Market price of a stock never comes from the balance sheet. Issue price does. Okay, so now this is a better statement. So you understand it's like this. Let's say I've issued one share, 10 rupees face value, and I issued that at a price of 50. I am preparing my first balance sheet. We will have cash of 50 here and total equity of 50. But this total equity of 50 would be divided into two parts. Equity share capital 10 and reserves 40. Once I have issued the shares at 50, that's it. After that, what happens to my market price, I never worry about it. Okay, so next day my stock price goes to 40 rupees, 30 rupees, 5 rupees, or it goes to 500, that will never come on my balance sheet. Then how will my reserves increase? Let's say that year I made sales of 50. I have made expenses of 30, which gives me a profit of 20. And a profit of 20 in a way would mean that my assets will also increase by 20. So 20 increase here and reserve 60. That's how the balance sheet moves thereafter. Is that okay? Non-current liability, which simply means long-term debt. Okay. So we have a long-term borrowing, a very small number of 8.44 crores. We can see the details in schedule 5. Yes. Long-term borrowing, loan from a bank 00, share of a joint venture 8.44. So, which diapers are those Huggies? HUL diapers? No one knows here? Never used one? Okay. HUL makes those diapers, I think Huggies. Okay, I'm not sure, but they have a joint venture with Kimberly Clark. Okay, and they in collaboration make those diapers. So HUL does not have a loan. That joint venture organization has a loan. Okay, and that proportion of that loan with some complex accounting method has come on this balance sheet. Okay, which you would get to learn at level 2. But as of now, what you would appreciate is that share of joint venture is the amount of loan. HUL does not have a loan, which means it's a completely debt-free company. And for a debt-free company, degree of financial leverage would be 0 or 1? 1. For a debt-free company, degree of financial leverage is 1. Because EBIT divided by EBT, since there is no interest, EBIT divided by EBT is going to be 1. Let's go ahead. Other long-term liabilities and long-term provisions. Most of the companies in India, this long-term provision would be made of provisions related to employees. Okay, so typically pension, gratuity, all those leaves that you promised them, all those would come here in the long-term provisions. Current liability, borrowings, trade payables. Trade payable means accounts payable. And if you'd see, the amount of trade payables is a substantially large number. Isn't it? We've discussed the strategy of HUL earlier, that it tries to stretch the payment. Other current liability, short-term provisions. Most of the companies in India, especially the listed ones, the short-term provision would be made of two parts. One would be dividend payable, dividend which have been declared but not yet paid, or dividend payable, and second, taxes payable. Okay, and hence we have the total. On the asset side now, so again what I want you to do is take total of these four numbers, which are your current liability, and calculate them as a proportion to the size of entire balance sheet, which is 12,091 crores. Total of these four numbers 1 2 3 4, and calculate them as a proportion to 12091, और वो total को लिख के रखना कहीं पे, total of current liability. %66%. Yes. This is a typical characteristic of a FMCG company, that about 66% of their size of the balance sheet is actually from current liabilities. Okay. If you would see some other segment of companies, you would find that this number would be substantially low, and we'll check that. Okay, but with FMCG companies, fast moving consumer goods, a very high proportion would be current liability and a very high proportion would be parked into current assets. We'll check that again. Going forward, assets, tangible, intangible, capital work in progress, intangibles under development. What is tangible? You can see or touch them, like land, building, all those are tangible assets. So a very big amount. A smaller amount in intangibles. Intangibles are softwares or copyrights or content, all those are intangibles. What is the meaning of capital work in progress? Yes, assets which are being constructed in-house. Okay, if I'm building a building for myself, but it's not completely erected yet, then that semi-finished building, it would be called as capital work in progress. Since it is semi-finished, we cannot charge depreciation. Following this? And therefore we do not put that into tangible assets. But once this gets completed, then this amount would be transferred to tangible assets, and then we will start charging depreciation on them. Same, intangible assets under development. Non-current investment, deferred taxes, all these items you will study later on. Loans and advances, other non-current assets, and then finally we hit the current assets. Again, see, the amount of inventory is substantially large, about 2700. Can you calculate current ratio for Hindustan Unilever? Please calculate current ratio. How do we calculate that? Current assets divided by current liability. So you have everything that you need on the screen. Calculate current ratio. Mm-hmm. 1.01, yes. 1.01. Take total of all the current assets, these numbers 1, 2, 3, 4, 5 and 6, divided by these four liabilities 1, 2, 3 and 4. How many of you getting 1? Okay. So have this in your records, write down somewhere. It's 1 point something. How much? 1.06? 01. So write down current ratio of Hindustan Unilever is 1.01. We will also calculate today current ratio of Dabur, Marico and few other FMCG companies, and then we will compare to them how well HUL is doing as of now. Okay, let's go ahead. Now on to the income statement. We have gross revenue at the top. Can you see what is the difference between gross revenue and net revenue? Yes, the difference between gross and net is the excise duty. So it's like this: if you go to a grocery store and you want to buy yourself a Lux bathing bar, you buy it for a price of 70 rupees. Out of that, maybe 7 rupees you are paying to the government in the form of excise. Okay, so HUL will take those 70 from you, the grocery store. but out of that 7 rupees it will give to the government. So technically it is not revenue of Hindustan Unilever, and that is the reason why we will start with gross less the tax on manufacturing excise, and then we will have net revenue. Using this number, can you calculate fixed asset turnover ratio for HUL? How do we calculate fixed asset turnover ratio? Yes, write down the formula. Fixed asset turnover ratio. Fixed asset turnover ratio is equal to sales divided by fixed assets. Okay. So for the purpose of this ratio, let's use the gross revenue. So your numerator is 28,487.26. 28,487.26 divided by, let's take only the tangible assets here, 2395.32. 2395.32. 11.89. And is it good or not good? Is it a good ratio? Good number, 11? Yes? No? How many of you feel yes? How many of you feel no? How many of you feel depends? Depends is the answer. It depends on what was the fixed asset turnover ratio of Hindustan Unilever in 2009, 2010, 11, 12. So maybe those years, if it was 16 and today it's 11, it's not good. But those years it used to be 8 and today it's 11, it's good because company is making more sales with less assets. It also depends on what is the fixed asset turnover ratio of Dabur or Marico or Godrej, the peers. And if those companies have higher than HUL, then maybe HUL is not efficient. Are you following this? So we will do both the comparison today. Let's go ahead. Other income. This is your non-operating income, which is typically made of interest and dividend receipts. Interest received and dividend received, that comes into other income. All the expenses, the first three are raw material related, then employee, finance cost. So see how much are they paying to their employees? 1412. Okay, can you calculate what percentage of their revenue is employee cost? So write down also in your books. Employee cost as a percentage to revenue. Employee cost as a percentage to revenue. 1412 divided by, take the net revenue, sorry, gross revenue, 28487.26. 28487.26. $4.95. So approximately they're spending about 5% on the employees. Yes or no? Now we would check this with a few other FMCG companies and find out how much the other players are spending on their employees. Okay, going forward, finance, which is interest, very small because a debt-free company. Depreciation 251, and then a substantially big amount of other expense 37. We can find out more about this number if you go to note 37. So I'm going there now. This is your schedule of other expenses. Quickly scan through this and find out the 2 or 3 biggest item. One is of course advertisement and sales. So calculate a ratio. Advertisement and sales as a proportion to net revenue. Advertisement and sales expenses as a proportion to net revenue. 3289.97 divided by, how much was the revenue? 27,586. 3289 divided by 27,586. 11.11. 11 point how much? 92. So about 12%. So whatever is the revenue, and say it's a big number. Whatever is the revenue, actually spending 20% of that revenue on the advertisement expense. Okay? And then we have some other smaller expenses here. Going back to income statement again. These are your profits and these are your taxes, minority interest. We have earning per share, which is nothing but profit per share. Let us calculate net profit margin. Net profit margin for Hindustan Unilever. $3828.98, but this time change the revenue number, divided by 27536, inclusive of other income, 27536, 13%. Is it good? 13%, good number? It's low? 13% is low? It's good for FMCG? Okay. The answer again depends. Depends on how well Dabur is doing, how well Godrej is doing. But yeah, FMCG is a low profit margin, high volume business. Which means when you buy that Lux bathing bar, HUL is not making a very high amount of profit, but the volume is really high. They're selling more number of units to compensate for lower profit margins. Okay. Let's look at few other balance sheets now.